Okay, guys, so welcome to the our third tutorial. And now, I really hope and believe that you've learned a lot from our two previous tutorial. Now, in this session, I just picked up one of the videos. It's an introduction about the breakout and resistance supports and stuffs, because now we need to. So please try to enjoy this video and learn more, as we're gonna be more practical.
A breakout occurs when the price breaks out and closes above a resistance level or below a support level. Let's quickly have a look at a candlestick chart to illustrate what support and resistance levels are. A support line can be identified by connecting the low points of an instrument's price. They are identified as low points if the price rebounded upwards right after reaching them. By definition, the support line needs at least 2 points to be formed, but we suggest finding 3 points for a stronger indicator. The support line can be horizontal or angled. Resistance lines are effectively the same as support lines, with the marked difference that they are above the current price and act as a ceiling from which the price falls from. Again, they can be horizontal or angled. When we have a support and resistance line together, they create a trading range, so both lines keep the movement of the price within a certain range until the price makes a break, either above or below. Trading ranges are formed due to supply and demand and market psychology. When the price breaks out of the range, it signals a change in the supply and demand and the beginning of an upward or downward trend. Let's say the price breaks out above the resistance level. At this moment, the resistance line might become a new support level as the supply and demand has shifted, so most likely new levels of support and resistance will be established. So here's the general concept to trading breakouts. You can use the breakout strategy to trade forex, stocks or commodities, and it works with any time frame. It's a method of technical analysis that follows certain rules and can be applied universally. So what's first? First, you need to find a financial instrument, a currency pair, stock or commodity with a clearly defined support or resistance level. We only need one clearly defined support or resistance level to anticipate a breakout. However, a trading range created by both a support and resistance level is more beneficial as you can take advantage of the breakout in either direction, so either above or below the current range. That said, how should you enter your order in a breakout? We will assume that you expect the breakout to be above the current range. So there are several ways to enter the market at a breakout, all depending on your trading style and risk tolerance. The first is at the actual breakout. To trade at the breakout, you would need to devote more time to actually watching the market so that you can place a market order whenever the breakout occurs. This is the most risky entry point as the movement has not been confirmed and there's a high chance that the price will move back into the trading range. The second entry type is a pending order at a price level placed above the current range. This is a preset price level that can be based on the current range or determined by an indicator. We recommend that the price level of the pending order is at a previously unachieved high. It does not require you to watch the market as the order will be executed automatically upon reaching the price. The third entry is to wait for the candle on the time frame you've selected to close above the range, reaching a new high and in this way confirming the breakout. We suggest that you exercise patience in order to confirm the breakout. Having the candle close above the range is one of the strongest possible signals for a continued upward movement. Once you have determined your entry, you'll need to have your exit strategy in place. A good way to determine a reasonable target profit is to analyze the previous price movements of the financial instrument. Your exit strategy will largely depend on the specific trading circumstances, trading style, your expectations, and the risk-to-reward ratio you're using. The balance you have to consider when placing your stops to exit your trade is to set them not too far so that you don't lose too much money if the market turns against you, and not too close so that small price fluctuations take you out of your trade too early. In this case, we could decide to place it right about here, which would be at our maximum permissible loss. One thing to look out for when trading breakouts is fake breakouts. Fake breakouts occur when the price breaks past the support or resistance level, but instead of continuing its movement, the price moves back into the previous trading range. So here we can see that the price breaks outside of the range but does not close above it. Instead, it returns back into the trading range and does not continue its movement upwards. So if you had placed your entry here, you would in fact have been caught in a fake breakout. In order to decrease your chance of trading a fake breakout, we suggest you wait to see if the price will continue to move in the intended direction. For instance, it's good to wait for a new high before going long. In this way, you will sacrifice some of the momentum of the trend, but you will ensure it's going in the direction you anticipate. Let's go to the Trading 212 Pro platform to illustrate a real live example of trading a breakout. Here we have the US dollar Japanese yen chart in candlestick mode at a 1-day time interval. Each candlestick represents the trading activity of 1 day. The first thing you needed to do is to have a clearly defined trading range. You can of course just have a support or resistance level, but we are going to go with the trading range as it's more beneficial. We see here well-defined tops, here and here, creating a resistance level, and clearly defined bottoms, here and here, that create a definite support level. Here we can see that the market has tested the highs and lows quite a few times, and we can be fairly certain the market won't hold this for much longer, and so you can expect a breakout. It may be tempting to enter the market when it's volatile and moving fast like over here, but this may lead to rushed decisions that won't result in the desired outcome. So a better strategy is to position yourself so that you're trading stocks, commodities or currency pairs that are currently low in volatility like we have here, and place your order so that it is ready to ride the trend whenever the breakout occurs.
Okay guys, so now that you've seen the video, then I believe you understand what's happening right there and what do we mean when we talk about the trading range, the resistance and support. So now I just open the graph here under a 4-hour time interval. So I'm just gonna try to analyze the market for the next coming hour and see if I could find a breakout in the market and decide which area to trade on. As you can see right there, we do have a gravestone there, and I have 2 shooting stars there. But because this is a 4-hour graph, it's still descending all the way down. So I'm waiting for the opportunity to present itself, and for me to be able to see that, I'm gonna use the trend line. Okay. Now, putting this into practical, it takes a lot of practicals to draw a trend line, especially a valid trend line that will guide you to which side the market is gonna go. So, for instance, if I start to draw my trend line from here, from this candle right there, and take it down here, it's not really a trend line. I don't really know what that is, because where will I put my support line when it's like that? Should this be my resistance? And if this is my support, where will I put my resistance? Because you can see most of these candles are outside of the trending line. So I'll do this and put it right here. Okay, and now if you trend line, you do it like this, it's still gonna open up a serious gap here. So this is not the trading range. Remember, we're trying to trace the trading range, the recent one. So I'm gonna make my trend line a bit tighter. Now, as you can see, I have a reject here, and this is a reject too, and it started on a reject, on a serious reject here and there. So when it's right here, I can still bring it down to this candle here. But now the problem is, if I bring it down like that, I'm still outside the trading range. So where does this leave me? I'm stuck with this candle. Okay, I'm stuck with this one right here. As you can see, it's nicely right underneath it. Now, as I observe right here, there was a breakout, but a reject. It came back right inside the trailing line. And right here, the same thing happened. And then it loses focus. It went down. Came back to test the market right here for some few minutes. Then it comes back down. So I'm hoping it's gonna come back to test the market again right here. So this is gonna be my resistance. Now I'm gonna turn that one to get my support. So it's gonna be on the lower shadow because my resistance is on the higher shadow. And still this one, I'm gonna make the same rule and put it right there. But now the problem is, if I put it right here, you can see this gap here. It tells me that the market, it came down to test the market here, to test my support. Now it's going back right here, and it did the same thing here, of which it did here and here. So we have a reject. 1, 2, 3. That's our reject here. But now, unless if I want to benefit from this peep here, from here to here, I can make a buy. My target is going to be just this area here. Okay, so I'm going to do this exactly there. I'm going to buy. I'm targeting this area here. Okay, you see this one, you can just, I know that you are using your phones, guys, so you can do this by grabbing it with the fingers. As you can see, the numbers are going up the moment I touch it here. So my aim is 35%. Oops. Okay, that's my 35% right there. Now, as you can see, what's already happening now, we are winning by 1% of my investment of $30.64. So by the time I reach here, I'll be having my entire profit.